Did you know when you see 3 green candles within a specific length, the next 10 candles will do around the same length? And this is a method of using how to read the markets, and this is something what works very well. We have trading students within the first 3 to 7 months. You can see here that they make with a not real money account $400 to $1,200 some weeks in between. Here you can see, for example, Martin, who had 5 winning trades and 16 losing trades and made $3,465. Or within a week, you can see how he made $500 and loses $300. You see here Diana, for example, who had 10 winning trades, made $3,716, lost 5 trades around $100 a trade, and made $3,313. Or you see Victor, for example, who had 4 losing trades and 5 winning trades and made $1,900. And this is a method that works very well using price action, not using any indicators, reading the candles. Very important is to understand sometimes you see 3 green candles in a row or 3 red candles in a row within a specific length. And very good would be if they are, of course, in a row and the next 10 candles will do minimum around the same length again, what is very interesting. And this works very well with the big picture, always what I'm going to show you in this video using a simple 3-step method. First of all, it is important to use the S&P 500 future using a 1-minute chart, because most moves that you see, we have weekly moves, we have daily moves. Daily moves, they occur like within 15 to 45 minutes. And when you use a 5-minute chart, you just have 12 candles within 1 hour. But using a 1-minute chart, the cool thing is just you have 60 candles within 1 hour. So now you can see better what the market is doing. Some people are saying it's more distorted. That means that it is hard to read the market, but it is way more easier to read the market using a 1-minute chart, because the 1-minute chart is telling you if the market is more likely to spike today or if it's a more easier to trade. It means like the market is more trending. So very important. Step number 1, the market always likes to go at bigger structure highs, as you see here, top here, or bigger structure lows that you see here. Once the market reach those targets, one of these, the market will try to back in and will it's about to orient again if the market wants to continue to go down or wants to go back in and then just like aim for smaller highs. For example, here you have smaller highs, or here like these highs here. And if the market is going up here, if the market goes higher, of course, it makes a lot of sense that the market goes then back to the bigger structure high. So you always have bigger structure highs and you have bigger structure lows, and you have smaller structure lows and smaller structure highs. That means bigger structure highs here. This is also from the bigger structure perspective a bit, but smaller structures are here inside all the red and green candles, and green and red candles would be good, just from the patterns, not reading the candles too much. Step number 2, when you can see that the market does lots of green candles or lots of red candles using a 1-minute chart, and it's more near to a specific reference, as you see up here, the market is more near to this high here, so it makes sense that the market goes to this high. Here, for example, it makes more sense that the market goes to this high. Once the market shoots down in this area, it makes more sense that the market goes to this low. So trading in this area here makes way more sense, I think, trading more down and then looking forward to the left now. Where do we find smaller structures or bigger structure lows? And when you look to the left, you will find here, for example, a low here. You will find somewhere, now we need to go in the 5-minute chart because this is the trading view version. Now you find here everywhere lows, and when you draw them in, you will see that the market is reacting there very well. So for example, you can see here this low here, you can see this low here, you can see, and those lows are very important, especially if there's a distance between here and there. If they're close together, very often the market will go there within one push. But if there's this distance here that is bigger, or here in between, you'll see how the market is reaching one time, one line. That's a retracement. That means it goes in the opposite side. You see how it goes in the opposite direction, and now it smashes back here. Usually I would have expected actually that the market cracks down both lines and then comes back up, but you can see how the market comes back and doesn't make it through this violet line here. And because it cannot reach one of these 2 lines, it shows us that the market wants to go up. So what doesn't go down comes back to smaller structure highs in this case. So once you understood this with step number 1, having highs and lows, bigger and smaller structures. Step number 2, that the market should do lots of red candles, as you see here. Lots of red candles shows us market is going down. We want to see also that length is also going down. The market is more near to a low than a high. Such things. Here you can see that the market starts making lots of green candles. Here you can see that the market starts to make a lot of green candles. And we have here the high. Does it make sense to trade here? It is almost impossible to trade here. It is not good to trade here at all. There will be days where the market is just wiggling around and we try to find maybe this one YouTube video to trade every day, but this is not how trading works. It's literally to understand when does it make more sense. That is, when does it make more sense that the market is near of at a high or near at a low. Here you can see, for example, it's more near at a high and it does more green than red candles, for example. This looks actually pretty nice. Also being here in the US session. And then once the market goes up, this is step number 3. And this is where the trading strategy shines that I want to give to you, is that when having a small color switch, such as a red and a green candle, when adjusting $100, that's why trading futures is so good. When adjusting $100 within just a green candle, that means if the market goes against us under this green wick, losing $100, if it's a $3,000 demo account, that is not real, please. But if the market goes in our direction, we would make $500, $700 for one single trade. And the cool thing is, on some trading days, for example, here, you will find 2, 3, 4 trading opportunities where this is possible. You find here red, green, for example, market aims for this high here. Red, green here, market goes up. Red, green here, market goes up. And each green candle of a color switch, when adjusting here $100, you can see how the market goes up with $500, $700, $800, so that's pretty nice. And I must also add additional here, concentrate always on number 1, that it makes most sense that the market is more near to this high than to this low. You can see that the market does more length up here than down is very important. You can see an uptrend also with a very big structure. And you can see also market does higher lows. And it does here more green than red candles currently. You can see here how the market presses up. Always the experience comes first, always when the market goes in one direction. And the trading strategy should just adjust you with money management, how to adjust $100 using a demo account first to make $500 in average sometimes. If the trade doesn't run well, we need, of course, to exit so early as possible. And so the trading strategy should just help you, and trading the market should be just like, should just feel like just how you do it with experience. When you see that the market goes in one direction, you want to see that your trading setup occurs. You want to see that you can adjust $100 to make $500. And if that's the case, then it's just all about time, different kind of market phases, and money management.